Okay, guys, we're going to go ahead and get started, and I'm going to go ahead and record this. I think some of you have said that you are listening to those now. Okay, so we'll go ahead and continue that process. Sometimes I won't put it up for the same class that you're in, but I'm going to go ahead and do it for this one, even though I already recorded this, just because I changed a couple things, so I want to get these up. If you hadn't seen the slides, they are up there now. So these sets of slides for Chapter 5. I was a little slow. I frankly forgot to put them up after our first midterm. So you'll see those now. Okay, so we're going to get into Chapter 5 now. And if you really, I did this again. I forgot the inventory, right? Yeah, I did the same exact thing yesterday. Okay, so let's go ahead and let's find that inventory example. And I think I handed out the sheet for that. Okay, and part of the reason I handed out this sheet is so because it is a little hard to see up here. Guys, is there a way for me to get rid of this this bar up here that we don't need? Click what again? Oh, and then to bring it back, what do I do? Click it twice again? And it'll come back? You sure? Don't get me out there in life and I don't have it. Okay. So I click it twice and it goes away. I click it twice and it goes away. Okay. All right, great. Because we don't need that, right? So give us a little more of what we want to look at on the screen here. Okay, so it's a little hard to see up here. If you don't have it, you might want to look on with somebody who did bring it. Okay, I don't have any. I didn't bring any extra copies of it. But we have two methods to account for inventory in the government. We have the purchase method and we have the consumption method. Okay, GASB allows for us to use either of these, although I have put a star here, notice, next to what? Next to the consumption method, because that is, frankly, the method that they prefer, okay, for us to use. But they'll allow us to use the purchase method, assuming it is not materially different from the consumption method, okay? Now, when we look at these, okay, when we look at these, we're going to first look at the purchase method. Okay, and notice that with the purchase method here, before we have purchased any inventory, we have cash of $100,000, and we're saying that that cash is all what? Unassigned, right? Okay. Then what happens? Then we go ahead and we spend that cash on inventory. And under the purchase method, we would go ahead and we would debit expenditure for the amount of inventory that we've used and credit cash. And as a result, for a second anyway, my balance sheet is out of balance, and we would just have to accept that until we do our closing entries, right? Okay, just like in commercial, if you whether you realize it or not, your balance sheet's going to be out of balance until you book your closing entries, right? Okay, so we go ahead and we don't have any more cash left, but we do now have this inventory, don't we? Now, as we begin to spend the inventory, use it up under the purchase method, in this example, I'm assuming that we use $45,000 of inventory during the year, we make no entry under the purchase method. We make absolutely no entry as we use the items up. Even though we've used them, we make what? No entry here. Okay? Then what happens? Then we go ahead and under the, again, purchase method is what we're following here. We prepare our statement of revenues, expenditures, and change in fund balance, which is like our income statement under the purchase method. And I'm assuming that our revenues were what? 0. Our expenditures, $100,000 just for the inventory. So we have a change in fund balance of negative $100,000. It's like a loss, right? Okay? And so what happens? When we perform our closing journal entries, we will go ahead and we will have to close the expenditure. How do we close the expenditures? Per our problem on the midterm, huh? We're going to credit our expenditures to close those. There's that credit to expenditure to close it, right? And we debit our unassigned fund balance just like we would in commercial to close our, we don't close it to retained earnings because we don't have it, but if there was retained earnings, we would have debited probably income summary and then retained earnings, right? Okay, but it ultimately reduces our unassigned fund balance. So if you look at the unassigned fund balance, even though we started the year with that 100,000, when we debit it, what? It now goes to zero, so our balance sheet's back in balance. No cash, no unassigned fund balance, right? Okay, but then under the purchase method, what they expect of us is we will set up a amount for the inventory, and so we'll go ahead and we'll debit inventory for what still hasn't been used. What still hasn't been used? Well, we purchased 100. We used 45, the problem told us, so there's still 55,000 that's unused. So we'll go ahead and we will debit inventory for 55,000. That establishes the inventory. And we credit non-spendable fund balance for 55,000. Remember, we said that our inventory is categorized as a non-spendable fund balance, isn't it? So we set up the inventory. We set up the non-spendable fund balance here for 55,000, don't we? If you're waiting for deeper meaning, stop. There is none. That's it. Our balance sheet is now all set. We show in the inventory of 55. We have to show the inventory of 55,000 because it's a current asset, isn't it? What did this thing do? Permanently mess itself up here now?
And then is the inventory balance only affected during the closing entries of the next year?
Hang on a minute. I've got like a major crisis on my hands here because this thing just like decided to pull a number on me. So 1 second. Don't save. Come back. This is all Nick's fault. No, just kidding. So right here, okay, sorry. I just get this thing back to where it was. We're sitting here and we have what? We have this non-spendable fund balance that we simply set up by crediting the non-spendable right there, right? And we debited the inventory right there to set up the inventory, right? I mean, my balance sheet was no cash, was all zeros, wasn't it? And I just debited inventory and I just credited unassigned fund balance. There it is, right? Right? What's the question now?
Then so for the next year, as you use up inventories, there's no...
You want to use inventory up in the next year? Is that what you're saying to me?
Yeah.
Okay, if you want to use inventory up in the next year, then we're going to have to go to the pad. I'll see it at the pad, right? Okay, so let's look at the pad, see what happens now. Sorry, guys, I'm not trying to push Becker on you. I think you all know that I teach for Becker, and that's not the point here. Okay, I just want to get to a tool that I know that is useful to me because I can write a lot more than I can on a PowerPoint slide. And I don't know why PowerPoint can't do this simple little thing, like put the pens and stuff right up there where I can see them. But anyway, okay, so you want to go into year 2? What's your name again, sir?
Craig?
Craig, you want to go into year 2?
Sure.
Okay. Don't be shy. Say, yeah, you're damn right. I want year 2, dude. Okay? So we're going to go into year 2. And in year 2, what do you want to do? Just continue to use that inventory that was there?
Yes.
Okay, so you want to go ahead and continue to use the inventory that was there. And we're in the purchase method? Okay, good. So we continue to use the inventory. How much do you want to use? We had 45,000. You want to use 10,000 more? Okay, so we use 10,000, and under the purchase method, as we use inventory, what journal entry do we make? As we use the inventory? No entry as we use, right? So we continue to not make any entry as we use. So now there's what? Now there's 45,000 of inventory, you tell me? Okay. And so I'll count up. I'll see that there's 45,000. I want my inventory count to have what? 45,000 in it now, don't I? So I'll go ahead and I'll credit the inventory for 10,000. If the inventory just kind of genning up a little T account over here, and I'm just going to go with, well, I'll put the whole thing. I debited it for 55, didn't I, last year? That was year one. So it had a balance of 55. And then, Craig, you just told me that they used 10,000. So I just credited it 10,000. So does the inventory account have the right balance in it?
Yeah. Okay, so it's just the same thing as last year. It's just the closing entries that affect the inventory balance.
Never interrupt an accountant in the middle of a journal entry. Okay, I've only credited something right now. When I was a kid, my dad used to tell me, don't bother the dog while he's eating. And I will always, until the dog turned around and went, ah! And then I knew, don't bother the dog while he's eating. When you get old, weird stuff like that comes back to you. I don't know why. It's just like, yeah, okay. What else did Dad tell me that I didn't listen to? Okay, so you credit the inventory 10,000. I have to debit something, don't I? I'm going to debit the non-spendable fund balance. How about that? For 10,000, right? And so when I debit the non-spendable fund balance, I had last year credited it, right, for 55. That was year one. So it had a balance of 55. And didn't I just debit it for 10? Does it have 45,000 sitting in there? Does my balance sheet balance? Okay, that's it. Don't you love accounting? We can change the world with journal entries. Look at that. Show me something else in this world that works perfectly like that. Nothing. Only accounting works like that.
You said we're making these journal entries at the end of year 2?
Yeah, when we count up the inventory and there's 10,000 less, yeah, we do that at the end, right? This is the periodic inventory system, isn't it? Just like the periodic system, you count at the end to see what you have left and you adjust the inventory account accordingly. Huh? What, that they're using the periodic?
No, just the guy that has to count it all at the end of the year.
Oh, yeah. That's why most of the companies these days use perpetual. And we're going to see in a minute that the consumption method is more like the perpetual system. Okay, and Gatsby says you really should use the consumption method, but they allow for the purchase method if there's not a material difference between what you do in the consumption and what you do in the purchase method. Okay, because let me ask you this. What would happen if I purchased more inventory? Let's say I purchased even more inventory, and instead of the balance going down, the balance went up. Let's say at the end of the year I count and there's what? 65,000 left. Now, that means, obviously, if there's 65,000 left, I must have, let's make it 75. Okay, so if I had purchased more inventory, then I would have gone ahead and done what? I would have debited my expenditure. What'd I say, 20,000? I don't like 20,000. 30,000? Okay, and I would have credited cash, right? 30,000? Okay, and let's say I use 10. If I use 10, what do I do under the purchase method when I use the inventory? No entry when I use the inventory, right? But I'm telling you I use 10, right? And so when I count up the inventory, I had what? I bought 30, I used 10. That means there was an extra 20. So I went from 55 to 75, didn't I? What do? I sit there and I debit the inventory for $20,000. I credit the non-spendable for how much? $20,000. Everything's matching again, isn't it? Okay. So yeah, you'd have to count to see what you have left. If you've increased, adjust up. If you've decreased, adjust the inventory down, adjust the non-spendable down, right? Man, this is going to be a great series of 12 questions on the exam dealing with inventory, right, Pete? Okay? All right. Just kidding. I'll probably give you a couple of easy ones. Okay? Question on that? Question on that? Okay, good. Now, you come over and let's look at the, what am I, in Excel here? Let's look at the, now the other method, which is the consumption method, which that we've said is more like the perpetual, okay? And, you know, a couple things. You said, oh, that's a bummer that somebody has to count that inventory, right? And you kind of indicated there that if we were using perpetual, we wouldn't have to count the inventory. Is that what you meant?
Just at the end, I meant.
Huh?
At the very end.
At the end of the year, we don't have to count, or periodically we don't have to count, whatever. Okay, even if we use perpetual, we still count the inventory, don't we? How come? To make sure you have it. If you always are like this and say, perpetual, the financial statement says we have all this inventory. When you open your eyes again, what are you going to have left in inventory? Nothing, right? Okay, so from an internal control standpoint, even if you're using perpetual, you should still count, right? Okay, just wanted to clarify that. Okay, now you come over and you take a look at the consumption method, much more like the perpetual. And what I'm going to do, before I go too far, though, into the next method here, I just want to point out, here's my balance sheet. I even showed you the balance sheet down here, which is inventory 55,000 and non-spendable 55,000 with our original example, right? Okay, and so now I just want to come over now and let's look at the what's that other method called? Consumption method. Okay, and when we look at the consumption method, I'm just going to go to this tab 2, which you may not have available because I didn't print that one last time, but you'll be able to see it it's on iLearn. Okay, I put it on iLearn, so it's there. But just let's take a look here now. And what happens? When we purchase the inventory, what do? We go ahead and we debit the inventory. We credit the cash just like you would in perpetual, right? And when I do, what happens? My inventory now has 100,000. My cash is now 0, isn't it? Right? I'm not going to show you the balance sheet again. You know the cash is 0 because I spent all my cash on inventory. At the same time, I update my fund balance so that I am debiting the unassigned fund balance, and I'm going ahead and doing what? Crediting the non-spendable fund balance, so the non-spendable fund balance now shows that I have that inventory in there, and my unassigned is now 0, because remember it started out with 100,000 because we had that cash up there, right? Okay, so everything's perfect, isn't it? Balance sheet is showing right at any point in time. We always, at some point, going to have to make sure if they drop an atomic bomb, the last thing the governmental accountant hands does is make sure that the non-spendable fund balance and the inventory account match, right? We always make sure that those two accounts match. That's got to match, right? Okay? Okay, good. Then what happens? Then as we use the inventory, we debit the expenditure, we credit the inventory in a manner similar. We don't have cost of goods sold, and these are supplies that we're using. We're not selling inventory. We're using up supplies, whatever. But we would debit expenditure and credit inventory as we use those. And so what happens? At the same time, there's my credit to inventory. I didn't tee up expenditure here because it's the only expenditure we're going to have is this 45,000, right? And so I go ahead, my inventory is showing 55,000, and at the same time, what do? I go ahead and I debit the non-spendable for 45,000 and credit the unassigned for 45,000. And so when I debit the non-spendable, is it showing the 55,000 now the way I want it to? Right? I credit it at the beginning of the year. As I use up 45,000, I debit it. It's showing the correct balance, and it's still matching the inventory, isn't it? Still matching the inventory? Okay. So now I just got to do my closing entries, don't I? And when I do my closing entry, I credit expenditure to close it. So now my expenditures are 0. I debit what? I debit the unassigned fund balance. And when I do, the unassigned fund balance, which for a second had come back up to 45,000, when I debit it to close the expenditure, it's back to 0, isn't it? So my balance sheet is once again showing me what? Showing me inventory of 55,000, showing me non-spendable fund balance of 55,000, which is the same thing it showed under the, what's that other method? Under the purchase method, isn't it? My big problem is always remembering the name of these methods. You will have to remember the names of them. I can't. Okay? I already passed. Okay? So everything. So what happens? You sit here and notice that what? The balance sheet looks the same regardless of the method, doesn't it? Balance sheet looks exactly the same regardless of the method. Which is how did we get there? Right? Okay. The only thing that's different is my statement of revenues, expenditures, and change in fund balance. Look at that. Under the purchase method, this thing is showing a what? Negative change in fund balance of 100,000. Under the consumption method, it is just showing what? Expenditure of 45,000 and a change. So there is a difference on the statement of revenues, expenditures, and change in fund balance, right? But GASB makes the point that if this government pretty much purchases and uses up the same amount of inventory year to year, then there really won't be a significant difference between the two. And so you can go ahead and use the purchase method if that's more convenient for them. So they do allow that. Thus, we have to know both methods. They prefer which method? Consumption method, right? Okay. Questions? Okay, so that's it there on that. Okay, so let me close that. Can I close this? Yeah, no more questions? Okay. And don't save because it's getting messier and messier. And let's go ahead and now pick up where we wanted to at Chapter 5. Okay, and the reason I thought of, what time do we get out of here? 6:20? Oh, we got lots of time. Okay, so what happens? The reason I wanted to, that I came back is I was thinking about the balance sheet, and I was saying we have covered our current assets now. We've covered what? Cash, taxes receivable were part and parcel of our discussion of revenue. Okay, we've dealt with what? Other current assets like supplies, prepaids like insurance would all follow those two methods that we just talked about, the purchase versus the consumption. You just look at what hasn't expired by the end of the year and make your calculations accordingly, right? So we've covered the current assets. Now we're going to get into the non-current assets, okay? And this is where we start to really dig into the differences between modified accrual and accrual as it relates to long-term assets because what? Under full accrual, we're going to treat those just like you've known for a long time, where you're going to set up your assets, depreciate them, all that stuff, versus what? Modified accrual, where we're going to be treating those as expenditures. So we're going to see a difference between what we do at the fund level versus what we do at the what? At the government-wide level, and it's going to be much more significant than we've seen in some of our other ones where we're still dealing with the current portion of the balance sheet, right? Okay. Now, although we did have pretty interesting differences in our revenue recognition, right? But other than that, it kept saying do the same thing almost at the government-wide level as you were doing at the fund level. Now, this book shows you the two entries and they compare them. Here's what we do at the fund level. Here's the entry at the government-wide level, right? And the way they've justified this is they keep pointing out to us, well, there'd be a dual-track accounting system that would be doing two different things at one level and the other. And I've said now a number of times, yeah, when pigs fly, that's how governments will do it. The reality is that governments keep track of everything at the fund level, and then they make what? They make consolidating, converting journal entries to convert the fund statements to the government-wide statements, right? And I'm going to get ready to send an email pretty soon to those guys and ask them if they'll come. They're probably going to say no, but I'll ask them anyway. Okay? All right, so maybe they'll show us that. If they don't, guess who's going to go through that exercise with you? Okay, but hopefully they'll come and do it because it's fun to have them come. Okay? All right, so let's just go ahead and let's take a look. When we talk about our assets, okay, land, building, typical types of assets, machinery, construction work in progress we're going to talk about, and that's going to be interesting because we're going to see how we will account for a construction project in the capital project fund, and that's going to be a bulk of our focus here as we go through. We'll also talk about something called infrastructure assets, roads, streets, bridges. This is what a government considers its infrastructure, and we're going to see that there's been some historical movement in the way we account for those probably over the last 20 years, I guess it's been now, versus the previous, 100 years or so of doing this before. And we're going to see that there's some special rules around those infrastructure assets. And only governments have to deal with infrastructure assets, right? Do businesses own roads, streets, and bridges? Who owns a bridge? The government, right? If someone ever tries to sell you one, don't buy it, okay? It belongs to the government, okay? All right, so let's go ahead and let's take a look then at how we're going to get the money for these things. And, geez, this thing is slow. So it's going to be what? Often we're going to get the money through bonds, okay? Be careful, guys. Are you all going to vote on November 8th? I said, I'll leave that on the recording. I won't edit it out so you get a few laughs. I said, are you going to vote on November 8th?
Yes.
Who said no? Okay, nobody said no. You want to vote on November 8th because what? I don't care about president or whatever. I do, but I mean, I'm not trying to tell you to not vote for Trump. But if you sit here and you look at actually what we do in California doesn't matter, right? I mean, California, you could vote for Trump 2 times, and it's not going to matter because California is going to go to the Democrats, right? So it really doesn't matter. One time my dad and I went to Las Vegas, and he starts talking to the lady behind the counter and says, okay, you got to vote for Bill Clinton. Vote, who are you going to vote for, right? And she said, I'm voting for Dole or whoever it was that was running against him. And my dad's getting real mad in front of him. Come on, Nevada's got 3 electoral votes. Who cares who she votes for? It's not going to make any difference. Okay, so anyway, what happens? We sit here and we have what? Tax-supported bonds. Oh, what was I talking about? On the ballots, they always put on there, do you want to approve bonds that will be issued to finance the construction of schools, and the bonds will be paid off over the next 30 years or something? And you sit there and you go, okay, yeah, help the children now, 30-year bonds. Sure, let's do that. That's 30 years from now, right? Meanwhile, what has to be paid on those bonds? The interest on those bonds, and often it ends up being the general fund that is the one that sends the money over to pay the interest on those bonds. That's money that's taking away from other things that you may think are of a higher priority than whatever the project is, right? So when you're looking at those things, make sure that you are satisfied that that is a good use of general fund money, because ultimately it's going to hit against the general fund, isn't it? Okay? All right, so anyway. Tax-supported bonds. Grants, the federal government will send us some money. Sometimes we'll get some transfers, and we'll talk a little bit about capital leases. San Francisco State capital leases, 301 or 302? 302. How many have taken 302? Okay. That's all right. We'll get you ready for it here. Okay, in here, and we'll deal with how we handle capital leases. Okay. All right, good. Now, you take a look, and we have our construction of our assets, which we'll keep track of in this capital project fund. And we're going to see that the general fund's not going to be talked much about here. Special revenue fund, not that much either. But they could all acquire assets. Okay. Now, we come over, and we will use the cost principle, just like you do in commercial. The invoice cost plus what? Plus transportation in. This is like the hardest thing that I teach my Accounting 100 students, because I tell them we have to pay for what? We have to include any costs associated to get that asset to where we can use it. And they're always like, what does that mean? Delivery costs, right? Installation costs, all of that stuff, what? Is going to be included in the cost of the asset. Okay? Okay, so you come over. Why is this thing acting up here? And we have what? We have our general capital assets, which we are going to capitalize at the government-wide level. So we'll debit assets for those. We will depreciate them, right? If we're accounting for them at the governmental fund level, we're going to treat them as an expenditure, right? And we've known that for a long time now. Okay. Okay, good. Now, there are certain types of capital assets that are not depreciated. For example, inexhaustible assets such as land. You don't depreciate land. Sometimes my, Accounting 100 students will say, well, what if the land falls off the edge of the earth? Okay, well, then you write it off when it falls off, right? But until that time, you leave it alone, right? Okay, you don't depreciate it. Okay, what else? Certain works of art, historical treasures, or similar assets are not depreciated, and we're going to see that we may even not carry those on our balance sheet. But you don't depreciate something like, this priceless piece of art. What's the depreciation on it? It may appreciate, right? Okay, now we don't write it up, but we certainly don't write it down. Okay, but we also have our infrastructure assets. And if we qualify for something called the modified approach, we will not depreciate our infrastructure assets, but we have to qualify for that, okay, that approach. Now, you come over, and this is something that I just put up on the slides today because I realized that I didn't like the way the slides were showing them before, so I changed this today, and like I said, I always seem to change it when I really look at it. Next semester I'll probably change it again, right? And so they tell us here that prior to GASB 34, recording capital assets was optional. Governments did not record their capital assets. Okay, so what happens? Since then, we do report capital assets, and of course, we know that we only report them where? On the government-wide statements, not at the fund level. We treat them as expenditure, right? Okay. Now, what happens? We have something called our infrastructure assets. We know that infrastructure assets refer to things like bridges, roads, gutters, drainage systems, whatever, right? These things belong to the government, okay? And so what happens? Governments need to report all of their infrastructure assets on their government-wide statements. So they have to bring them on. In the old days, they did. Okay? Now, do governments have to record buildings on their financial statements? Do they have to report buildings on their financial statements? Huh? Okay, I'm talking about the government-wide level now. We're talking where we're using full accrual accounting. At the fund level, none of this happens. This is only at the government-wide level that we're talking about for infrastructure assets, and which are things like what? Things like bridges, gutters, etc. Not buildings. Buildings are not infrastructure assets because what? They're not a bridge, they're not a street, they're not a gutter, right? They're a building, right? And so, do we have to report buildings? Huh? Yes, we do. We have to report all of our capital assets, including what? Including the infrastructure assets, which are these things up here. So I'm just trying to make that clear. We put all assets, equipment, buildings, and infrastructure assets such as bridges, streets, gutters, drainage systems. The Hetch Hetchy water system is an infrastructure asset. Do you like the Hetch Hetchy water? The water that comes right out of the tap here in San Francisco is like the best in the country. I always laugh when I hear people at the restaurants go, "Can you put lemon in our water, please?" And I'm like, "Look, we're not in LA. Okay, this is good water here. You don't have to put lemon in it, right? It's one of the best water systems in the country."
But the parking lot.
Parking lots are not considered an infrastructure asset. To really be an infrastructure asset, you have to be part of a system. Okay? For example, the Bay Bridge is an infrastructure asset because it's part of a system, isn't it? Have you ever driven across a bridge that isn't part of a system? If you did, you're not here to talk about it because it fell off into something else. It connects up to a road that goes somewhere else. That's a system, isn't it? Okay, so infrastructure assets are typically part of a larger system. Parking lots are not connected up and considered a system. So no, parking lots are typically accounted for as enterprise funds because you pay and you park, right?
What if for the government employees? Just like
No. What do you government employees, it's part of their benefit package. I don't know. Okay. So what happened? We're sitting here. I'm sorry. What do you want to know about government employees? I'm sorry. Go ahead. You want to know something about government employees?
Says it's part of building and land improvements.
so it's like they have a benefit. So
What?
The book says it's part of building improvements and other than building.
Parking lots are?
Yeah. Fencing and landscaping, land land improvements including land attachments of permanent that are permanent in nature, walks, retaining walls, parking lots, fencing and landscaping.
Is what?
Land improvements.
There's a land improvement. It's not an infrastructure asset, right? Okay. Now, what do you want to know about the employees?
well, the thing is that doesn't provide that some like a parking space for the employees,
Right.
and then so it should be like like the bridges or streets like part of that system.
A bridge is only a parking lot between 4 o'clock in the afternoon and I'm not sure what you're asking me.
It's like what about like the people who work at the Golden Gate Bridge?
Right.
So the employees, the constructor employees, they do that stuff, and then they have to park their car or truck. So side of there's a parking space that it could
Okay.
be
A
like
bridge parking lot.
Okay. You're asking me, do they account for a bridge parking lot as an infrastructure asset? I'm thinking no. Okay. Okay. Now, so what happens? I'm not sure what you're asking me, and I'm thinking we're getting a little granular. Here's why I'm acting like an ass. Yeah, okay. So we have what? We have our infrastructure assets, right? But governments also have other assets like Nick just read off to us. Land improvements are also assets. Buildings are also assets, but they're not what? Infrastructure assets. To be an infrastructure asset, you have to be part of a system. Like the Hetch Hetchy Water District is part of a system because what? They have to have the pipes that take it from one place to the other, lift stations to get the water up before it comes back down. They use gravity, they use electricity. There's a whole thing to get the water. You come and you press the button and you say, Meanwhile, all kinds of stuff went into it. In fact, where the pipes run through to get to San Francisco, what great city do they run through to get to?
Hayward.
They run through Hayward to get there. So Hayward gets Hetch Hetchy water as well. That's why I think it's so great, because it's in Hayward. Now, what's bad about it, when you get the water in Hayward, you have to go to a pipe and you just have to hold a bucket there where it kind of leaks out on the side. No, just kidding. It comes through the water faucets and stuff too, okay? One time I was on an audit, and we were looking at how the government helps native tribes that live on the reservation and colonials and that kind of thing. And by the way, they don't help them hardly at all. They just basically throw them out there with very little infrastructure. And two things about that. One time they were upset in one of the interviews, and they're saying, your government has done this and your government has done that. And I'm saying to myself, I'm Puerto Rican. Okay, but anyway, what happens? So we have all these issues, and then I'm in one of the interviews, and they say, we don't even have the infrastructure for a water system. We have to get water from a water buffalo. And I'm like sitting here going, because I had to write up that interview. I got stuck writing that one, and I'm thinking, how am I going to explain this in the interview? They get water from a water buffalo. So I said, excuse me, how do you get water from a water buffalo? And they just started, look, everyone started laughing. It's a tank, right, where you have to go. But that's how you have to get your water, guys. If it's no infrastructure asset like a water system, you got to go to a tank to get water. Okay, it doesn't just come here by, God didn't wave a magic wand and bring it, right? So this is a what? Significant infrastructure asset that we would account for, right? Okay. Now, in the olden days, the government the GASB, I should say, didn't even require that we have put infrastructure assets on the balance sheet. They didn't require us to do that. Then GASB 34 came along and said, nope, you got to put the infrastructure assets up on the balance sheet. Now, if you can imagine, that's a pretty big job, isn't it? To take something that significant that you'd never had on your financial statements before and then all of a sudden put it up there, right? Okay? And then they said, and the required approach is that you depreciate it. And the governments went nuts. Okay, you're killing us, GASB. You're making us put something on our financial statements that we never had on there before, and now you're telling us like something big like an infrastructure asset, and now you're telling us I have to depreciate it? Think, you're the city of New York. You got the Brooklyn Bridge that's been out there since the 1800s. Now you got to sit there and all of a sudden bring it on the financial statements and depreciate it? So GASB took pity and said, okay, we will not require you to the required approach is that you depreciate your infrastructure assets, but we'll give you a modified approach. And under the modified approach, you will not have to depreciate your infrastructure assets. Okay? So amounts that you spend are going to simply be treated as expenditure unless it results in an improvement. So if you add a couple lanes to the San Mateo Bridge or something, I don't know why they call it the San Mateo Bridge. Why do they call it the San Mateo Bridge? It goes from San Mateo to what? Hayward, so I'm going to call it the Hayward Bridge. So if you're sitting there and you're dealing with the Hayward Bridge when they added lanes to that here not too long ago, that would be capitalized, right? But any other amount you spend are going to be expensed, treated as expenditure, and you don't have to depreciate under what? The modified approach, which is only available for what type of assets? Only available for infrastructure assets that are part of a what? Part of a system, right? We do not have to depreciate them. If we spend money on them, we treat that as expenditure unless it results in a major capital improvement. So what happens? If you add a couple lanes to the bridge, yes, capitalize that. If you sit there and you just redo the road bed, just treat that as an expenditure, right? Okay? Okay, so that's considered the modified approach. But to be eligible for the modified approach, we have to meet a couple of requirements regarding our infrastructure assets. So let's just go ahead and take a look at what the requirements are. One, we have to have an asset management system, and the asset management system has to allow us to go ahead and keep an up-to-date inventory of our eligible infrastructure assets, and we have to do a condition assessment of those. When we do a condition assessment of those, we are literally going to go through our infrastructure assets and say whether or not we think they are in good condition, I don't know, fair condition, I guess. There's no requirement as to how we characterize this. Or what? Poor condition? Okay, so we have to have a system that allows us to do an infrastructure assessment of our infrastructure assets, and we have to include documentation that is providing reasonable assurance that we are maintaining our infrastructure assets at or above the most recently completed condition assessment. Now you look at that, and when we talk about something like reasonable assurance, what discipline calls in reasonable assurance? What discipline brings in the idea of reasonable assurance? What class have you had where they talk about reasonable assurance to you? The audit class, they've talked very good. The audit class, they talk to you all the time about reasonable assurance, don't they? Right? And so what happens? They're helping the auditors here, guys. When Gatsby was going to come out with this standard, they must have turned to the auditing profession and said, look, when we're dealing with an entity that's going to be using the modified approach, what will help you to make sure that they're correctly following the modified approach? And I guess the auditors must have said what? Well, we want a system that allows for this condition assessment, and we want documentation that's going to provide us reasonable assurance. So if they're going to use the modified approach, they're also going to have something that helps the auditors to determine that they're properly following the modified approach. Okay? Now, what I'm interested in all this, guys, is not the requirements for the modified approach. I could care less. I am interested in that you know what has to be reported if a government chooses the modified approach. And there are two, what's RSI? There are two required supplemental information schedules. So we're now in the bottom box of the GASB 34 reporting model, aren't we? Right? Two required supplemental information schedules, and the schedules need to show the condition of the government's infrastructure and a comparison schedule needed versus actual expenditures to maintain the condition assessment. So if you look at the RSI, if you look at the RSI for a city, you would see two schedules. One is going to be a condition assessment. So you'd see something like this: 10,000 miles of road. This is for their infrastructure assets. Good condition. 15,000. Isn't this a song? 15,000 miles of road, fair condition. I'm sure I've heard that somewhere. Okay, 15,000 miles of road in fair condition, and then 100,000 miles of road poor condition. You see why they want them to have a system to do this? Right? If I'm an auditor and they're reporting that, I need something to help me to show that they've gathered this information correctly, right? So they have to have a system that allows them to do this because they're going to report this as part of their RSI. Okay? Now, what happens? The second schedule, how many schedules do they have to have? There's the one with the condition assessment. The second schedule is going to say for the poor, well, for the good. Let's just do the poor, guys. I don't want to do every single one. I want to turn this into a 50-minute discussion here. Let's just do the poor. For the poor, budget to maintain. Budget to maintain poor is 10 million. Actual that was spent, actual that was spent, 8 million. Actual that was spent, that says 8 million. Actual that was spent, 8 million. Do you want to drive in the roads in this town? No? Because what? They're already got, what, 100,000 miles of road in what? Poor condition, and what? For those that are in poor, to maintain what's already a crumbling infrastructure, they should be spending 10 million, and they're spending what? They're spending 8 million. It's bad and it's getting worse, isn't it? So if a government thought that by taking the modified approach, they would sidestep having to report a rapidly deteriorating infrastructure by reporting this huge depreciation number against it, think again. Although you'd have to be a nerdy accountant, but you could get down into the RSI, pull out this schedule, and take a look and see that, no, they're not doing a very good job maintaining their infrastructure at all, are they? Okay.
Is it possible they can do that? So let's say there's a budget for the good condition and the good condition. They can transfer a little bit partially from those two to the close to $10 billion.
Budget to maintain good is 0. Actual is 0. Budget to maintain budget to maintain good is $1 million. Let's make it even worse story. Budget to maintain good is $1 million. Actual is 0. Budget to maintain fair is $2 million. Actual is 0. Are you happy? They took all their money and they put it toward trying to help what's bad and getting worse. You got any cash? Can you help them out?
So what I'm saying is like, okay, so actually 0, so they can transfer from the $1 million.
They ain't got the money. That's what they would need to budget to maintain good, but they ain't got it. That's what they would need to budget to maintain fair, but they ain't got it. They need 10 million to fix the dying, and they only got 8. What do you want them to do?
I want to transfer that to.
They ain't got it. Just because they said that's what they need to budget to fix it doesn't mean they have the money.
Oh,
They ain't got it. You're thinking, well, they had the money for that. They got an appropriation for that. You know, when we say budget, they mean what they would have to budget, but they ain't got it. So needed is maybe probably a better word. In fact, I think that's what the slide said, and maybe I messed you up by putting the word budget. Needed. Now it makes more sense, right? They ain't got it. Now you're looking at this and you're saying, okay, John, this is an extreme example. No, this is the condition of much of the U.S. as it comes to infrastructure assets. This is the situation. They need money to keep a rapidly deteriorating infrastructure afloat, and they're having trouble. Okay? This is where Trump blew it. Trump could have made this his key issue. Why would have Trump been able to make this his key issue?
No one would understand.
Well, that's... No. That was the reason he didn't make it his key issue. Everybody understands. Oh, crooked Hillary and her husband. Whoops, I forgot what I did. Okay, so whatever, everybody understands that. That's why they focused on that. And if you get the pendulum swings the wrong way on you on stupid stuff like that, you end up losing, right? Okay, but what happens? What if he had made this his key issue? Why would have he been in a good position to do that?
Because that it grows jobs. It's going to pump a lot of money into fixing the
Beautiful.
infrastructure.
It brings in jobs to fix the infrastructure. Can you think of someone who might be qualified to talk about building?
The wall guy.
Because he should have dropped the wall. He should have said, look, I'm a builder. Here's where we're at. This is how we're going to improve the economy, fix a problem. I'm going to be in charge of it. I can do this. Everybody would have said, now we got something that we believe in, right? And meanwhile, he could have sat there and said, and Hillary did this with her emails, and she's bad because of this reason and that reason. Okay? I don't know why he didn't do it. I think the guy's got a serious problem. Huh?
He lost $1 billion in bankruptcy.
Yeah, but nobody cares about that. Okay. Anyway, I didn't want to turn it into, I don't know, I got it all that. Okay, so stop. Okay, so these are the 2 schedules that they have to prepare, right? 2 schedules, which is what? A schedule showing the condition assessment and what? A schedule showing the actual versus needed expenditures to maintain the condition, right? That's the key thing I want you to know. Okay, good. Now you come over, and by the way, I keep talking about Hayward. Has anyone here ever been to Hayward? You've been to Hayward? What happened? You got lost? Your aunt lives there? You went to check on her, see if she was okay? You been to Hayward? You guys related? Have a party. I know a good place to go. Okay? You can go to Los Compadres. Good place to go in Hayward. Okay? Now, what happens? When you go to Hayward, after you go to Los Compadres, go down the street to the Hayward Historical Museum. It's on Foothill Boulevard, downtown Hayward. You go down there. It's got everything about the history of Hayward in there. It's got so much about the history of Hayward in there, it'll take you 20 minutes to go through it, okay? And if you go all the way to the back, they have the 3 pitchforks that were used to start Hayward. There's a golden pitchfork, a silver pitchfork, and a bronze pitchfork back there. Those are those pitchforks that were used to start Hayward, okay? Now, let me ask you, should Hayward put those pitchforks on their financial statements? Are they required to? Are they required to? And you take a look up here, and they say what? They are encouraged but not required to put historical treasures, work of art on their financial statements as long as they do what? As long as they meet these 3 requirements that you see here. 1, the collection is part of a public exhibition. It is cared for, and the city is subject, the government is subject to the policy that if they sell one of those collection items, they have to use the proceeds to purchase other collection items. And if they meet all 3 of those, they got to meet all 3 of those criteria, then they are not required to keep those assets on their financial statement. They don't have to report them. Okay? 3 requirements, right? Got to meet all 3 of them. If you meet all 3 of them, then you don't have to put those assets on your balance sheet. Those historical treasure, work of art, whatever, okay? There's no pitchforks back there, okay? I just want to make sure because I had the experience that I told that stupid story, and then somebody said, I didn't see the pitch. Where are the pitchforks? Are they all the way in the back? I'm like, sorry, that was just a joke, okay? There's not really a pitchforks back there. Okay, now you come over and you take a look at what happens when we purchase equipment. And you can see, guys, that if we're at the government-wide level, what type of accounting are we using? Good, full accrual accounting. And if we're using full accrual, just like you did when you were 2, debit equipment, credit cash, right? If we are using modified accrual, we debit the expenditure. And we've known that now for a long, long time, right? When I say long, long time, as we've gone through this class. Okay? Okay, good. Now, they tell us that if we are going to lease an asset, we follow certain criteria to determine if it is an operating lease or a capital lease. My Accounting 302 guys, are they still teaching you the criteria for a capital lease, or have they abandoned that now? They're still teaching it? Okay, so the criteria to treat something as a capital lease is what? There has to be an ownership transfer. Who taught this to you? Who? Okay. Okay. Professor Duke. Got to be an ownership transfer. Okay. Has to be what? A written bargain purchase option. Present value of the minimum lease payments have to be greater than or equal to 90% of the fair value of the property. And the term of the lease has to be greater than or equal to 75% of the economic life. How many of these do you have to meet? You only have to meet one of them, right? Okay. So if you have an ownership transfer, written bargain purchase, present value of the minimum lease payments is greater than or equal to 90% of the fair market value of the property, term of lease is greater than or equal to 75% of the economic life of the property, you meet any one of those, you owns that property, don't you? And you have a capital lease. Okay. Now the criteria is changing, and so that is sort of going to be old pretty soon. GASB has the same criteria, but because that criteria is changing, I don't care about the criteria. All I want you to know is once you get into a capital lease situation, okay, you're going to have to follow this accounting. Okay. Now what do? You take the present value of the minimum lease payments. And when you take the present value of the minimum lease payments, if we're accounting for that at the government-wide level, what type of accounting are we using at the government-wide level? Full accrual, and you're going to follow full accrual approach there, where you're going to go ahead and debit equipment, and credit this obligation, capital lease obligation payable. So that's a liability, aren't you? Okay, so you're going to go ahead and you're going to do what? You're going to set up the equipment for the present value of minimum lease payments. You're going to set up the liability for the present value of minimum lease payments, just like you probably learned from Professor Duke, right? With me so far? Okay. Now, in government, when we have bought equipment, what have we done in the governmental funds? When we bought equipment, what have we done? Under modified accrual. We debit expenditures, haven't we? Isn't that what we just did here? We debit expenditure? Okay. In government, when we do what? When we issue long-term debt, what do we credit? Don't we credit other financing sources? So we're following what we've already said now for this lease. When you acquire the property under capital lease, you can't debit equipment. So what do you debit? Expenditure. You can't credit a long-term liability like you would under full accrual for those future lease payments. And so you credit other financing source, don't you? With me so far? Okay. Now, in this little example that I wrote in here, I said pretend that the interest rate on this lease is 10%. You see that 10%? See that 10%? See the 10% I wrote in there? 10% is the interest rate on this lease. And so each year we're going to accrue a liability here, aren't we, of interest expense of $5,000, 10% times the 50,000. All right, so we've got this $5,000 interest expense. And I said in this example that the payments each year are $15,000. So we have to pay $15,000 every year on this thing, don't we? When we pay that $15,000, what happens? $5,000 goes towards interest expense, and the remaining amount is going to pay down that obligation on the lease, isn't it? Right? So we go ahead, we credit cash for $15,000, we debit the interest expense for $5,000, we debit obligation on lease for $10,000, right? We're paying down that liability. Full accrual accounting, just like you would in 302. This is the same way you'll do it in 302, right? Now, I didn't put it on this slide. What's going to happen in year 2 on this thing when we pay the $15,000 in year 2? I didn't think of this last night. What's going to happen in year 2? Can I write year 2 up here and get away with it? Huh? Well, I'm going to credit cash for $15,000. You got that right, Zeth. So I'm going to just go ahead and credit cash. How much? $15,000 we're saying in this example? I like how people decide when to take a break, you know. Okay, here, ready? Now that they left, here's the answers to the next exam. A, C, D, D, A. Right? I mean, you don't know what I'm going to say that's going to be relevant to the exam. You decide, okay, I'm going to take a break now. Okay, so what's happening? I credit cash for $15,000. Now what? I still got to credit cash for $15,000. What was the balance on this thing? If it started at 50 and I just paid down the obligation $10,000, what's the balance there now? Now the balance is what? $40,000. What's the interest rate on this thing? 10%. So that means my interest in year 2 is what? $4,000? So in year 2, I'm going to go ahead and I'm going to debit now interest expense. Can't believe this thing's letting me write up here. Interest expense is what? $4,000. And now the obligation, the liability is going to be debited for how much? For $11,000, right? Okay, so we've gone through the full discussion here now for commercial. Year 1, year 2, whatever, and we just continue on like this. And I don't know if this would be amortized properly with $15,000, guys. I'm just making this up, so don't sit there and say, well, wait a minute, you know, you would never pay it off under those. I don't know. I didn't just made up the $15,000, right? Okay. Now, under government and we would do that at the government-wide level. For our governmental funds now go back, and when we make the lease payments, notice we debit expenditure and we credit cash when we make the lease payments. Why? Because we're spending cash, aren't we? What do we do in year 2? When I make the lease payment, got to make this $15,000 a year. What do I do in year 2? I debit expenditure for how much? For $15,000, and I credit cash, obviously, every time I spend cash for $15,000, right? So I make the same journal entry year after year as I'm making the lease payments here at the governmental fund level under modified accrual accounting. Okay? Now, you look at that and you say, well, isn't that a double counting of expenditure because you debited expenditure here and then you debited expenditure here when you made the payments? So you counted those expenditures twice. We also, though, when we acquired this asset, we debited expenditure, but we also credited what? Other financing sources, so it was a wash on fund balance, wasn't it? The expenditure would have negatively affected fund balance, but the other financing source would have brought it back up, right? So it's a wash on fund balance. The fund balance doesn't go down until I actually start using a current financial resource. Cash is the most current of financial resources. When I start using that, then my fund balance is going to come down, isn't it? So it's really not a double counting, is it? It's really not a double counting, is it? Starting from...
So the double accounting part, because here the expenditures and other financial sources. So the year 2 we have an expenditure and a cash on the other side when we do payment. So
Are you talking about this part right here? Is that what you're talking about? You're talking about this over here, huh? The top part?
expenditure.
Okay, I debit expenditure, I credit cash, $15,000 as I make the payments, right?
Yeah.
And in the year 2, when I make my payment, I debit expenditure, I credit cash for the same amount, right?
Yes.
Each time I make that payment. Okay. And it just keeps going like that till I'm done, till I get out of this lease.
Yeah.
Till I'm done with this lease, right?
Yeah.
Okay, what do you want me to tell you?
The part is other financial sources, capital leasing.
Okay, so all I'm saying is the impact on fund balance when I acquire the asset, because sometimes students look at this and they think there's no way that it could be right that I debit expenditure when I get the asset, and then I debit the expenditure when I start making the payments. I'm double expendituring, as though that were a word. Okay, and what's happening? I'm saying no, because what? You sort of undid the impact on fund balance here by crediting other financing source, didn't you? So it went up. It came down, didn't it? Other financing source brought it up, expenditure brought it down. It washed out on fund balance, right? But when I'm sitting here and I'm actually using cash, now I'm going to debit expenditure and my fund balance is going to come down, right? By the amount of cash I'm using? That's what you want me to say again? Okay. So what's that last part again? So there's no impact on fund balance, right? Okay? Okay, good. Now you come over, and the reason I make a big deal and the reason I'm like, hey guys, this is not the class to miss, blah, blah, and people decided to take a break, I guess, is because if you're on the exam, you're looking at my exam next time, you're going to be sitting there and you're going to be all over this. You're going to remember all this discussion, I should say, as to how we deal with the treating an expenditure when we buy it and treating it as expenditure when we pay the lease payments. Everyone else is going to look at that and go, there's no way that's correct. Oh, that's the weirdest thing I've ever seen. Because it is kind of weird, isn't it? Until you really think through it. Okay? Okay, good. So come over then, and let's take a look at what happens when we dispose of an asset, okay? And when we dispose of an asset and come to our governmental activities, and we're in governmental activities, the government-wide level, what type of accounting are we using? Full accrual. Okay, so we're sitting here using accrual accounting, just like you would if you sold off a completely depreciated asset. You would debit the cash for whatever you got. You would debit the accumulated depreciation to get rid of it. You'd credit the equipment to take the equipment off the book since you're getting rid of it. And since we sold this asset for more than its carrying value, we have a gain here, don't we? Right? If we're sitting here and we're dealing with modified accrual accounting, saying the general fund, there is no asset to write off. All we have is a current financial resource of $500 that came in, right? And so we obviously debit the cash. And this one's saying credit other financing sources, proceeds from sale. I've also seen it called other revenue. And I asked MGO when they were here last time, so is it other revenue? He said, you can tell me. Is it other revenue or other financing source? And they said, we don't know. It's whatever. I mean, it's not something that has been called out real specifically in standard. So it can either be other financing sources or what? Other revenue that you'd call that. Okay? Okay, good. So that's when we dispose of an asset. Now you come down and you take a look at this next slide. Okay, and I'm going to come to special revenue fund later. Special assessment later. Okay, for this one, this is the big discussion now for this chapter. Okay, this is the capital project fund. I don't know. I think I'll keep all that, I guess. Okay, so here we've got the capital project fund. You can still see that pretty good, right? Okay, because what I want to do as we go through this capital project fund is I'm going to keep track of two accounts. Okay, and somebody told me that I should be able to write over here and over here. Good, I think it's going to work. So what I'm going to do is I'm going to keep track of my cash. Can you see that? And I'm going to keep track of my expenditures on this project. Okay, and in this example, we're building a city office building, we're building a county courthouse, whatever. We're building some sort of general fixed asset, right? And we're going to raise money in the capital project fund. This is the capital project fund example. We're going to raise money in the capital project fund, and then we're going to spend the money out of this capital project fund to construct this asset, right? This is what the capital project fund does. Okay, so we go ahead. And first thing that happens is the federal government says that they're going to give us some money. Now, they haven't given it to us yet, but they tell us that they're going to give us some money to build this asset, right? So we debit due from the federal government. We credit revenue, right? And notice, guys, that we're still crediting revenue down here at the government-wide level. It's just that now they're calling it out as a program revenue, a capital grant, okay? But it's still revenue, right, in both cases? Okay, we're not getting into revenue recognition rules here. We covered that already. Just assume they've met the revenue recognition rules. They're calling it revenue, right, as it comes in. Okay, then what? Then we come over and we need some money to begin some work, and we don't have the money. So that's the one problem of trying to keep track of the assets. Theirs is we change the cash and stuff. Theirs we change slides. It's not there anymore. That's not good. So we go back to the pad. What assets are we going to keep track of? What accounts are we going to keep track of? Cash and what? Expenditure. Okay, we're just going to have to do it this way. This is a little clunky, guys, but it doesn't keep the sidage there if you do it the other way. So I'm going to just do it here. Okay, so debit cash. We have the cash, we have the expenditures, and then if you look back at the slide, okay, they need some money for blueprints to be drawn or something on this, and they don't have the money yet because the federal government hasn't sent them the money. So the general fund says, hey, I'll loan you the money. Remember we talked about that where what? You could have money that comes from the, say, capital project fund, from the general fund, but if it's not just transferred, it's not other financing source, it's a loan, isn't it? So the capital project fund has some money that it owes to the general fund. It owes them $50,000, doesn't it? But do we have some cash now? Debit cash. We have some cash now, don't we? Okay. Okay, good. So we come over, and I'm going to go ahead, and since we have some cash, I'm going to go ahead and debit my cash 50,000, right? What's the balance in here? 50,000. Right? Okay, good. So I'm going to hide that, and I'm going to go back here. It's a little clunky is how I get back and forth, but I can't. I thought I could draw it on the side, but it goes away when you change slides. Okay? With me so far? Okay, so we've got that cash, and then what? And then we go ahead and we find an engineering company, whatever, to draw us the plans, and they agreed to do that for 50,000. So we debit encumbrance, we credit budgetary control. The reason I went easier on you for the first exam is so that you've got this stuff under your belt. Now you're going to really have to show me on the next exam that you really know how to use this stuff. If I give you a fact pattern like this, you got to know, hey, got to debit encumbrance, got to credit the budgetary control, right? And then the engineering company goes ahead and bills me for this. And when they do, I debit the budgetary control, credit the encumbrance for the original amount. I debit what? I debit expenditure, credit cash for the actual amount, don't I? So have I used up some cash here? Have I used up some cash? Okay, so let me go back to my pad, and let me now credit the cash. So how much cash do I have left? 2,000. Guys, if you don't know, bust out a calculator. And I'm going to do what? I'm going to debit expenditure here of 48,000. Right? Okay. Okay, good. So I'm keeping track of my expenditures. I'm keeping track of my cash. That's all I'm doing over here. Meanwhile, back at the project, I'm sitting here and I am not only recording this at the individual fund level, the capital project fund, I'm also doing what? I'm also over here in my government-wide level keeping track of an asset that I'm building. It's construction in progress, isn't it? So I'm debiting construction in progress as I'm building this thing up. Full accrual accounting. Construction in progress and asset. Right? Okay. So now what? Now I come over and I get some money from this bond issue. So I issue the bonds for $5,050,000. I go ahead and I credit my other financing sources for the $500,000. I can't draw on that because it won't let me. I'm going to go ahead and do what? Credit the $500,000 for the other financing sources because this is long-term debt. I mean, not $500,000, but $5 million, right? And I'm going to take that $50,000 and I'm going to put that as due to the debt service fund. Usually governments issue bonds at a premium, and they do this because they want to get a head start on paying back the principal and interest, and they typically write into the bond covenant that that $50,000 has to be sent over to the debt service fund for the protection of bondholders, right? Debt service fund is going to take that $50,000, hang on to it, invest it, maybe get some other money so that when the principal and interest come due and when we get to Chapter 6, they're going to use that money to pay back the principal and interest, aren't they? So that extra $50,000 is going over the debt service fund. The capital project fund is going to keep the $5 million to construct this office building, whatever, right? And so that portion that they're going to keep, we treat as another financing source. The amount that they're going to send over to the debt service fund, we're going to call due to the debt service fund because that's where it's going. Okay, so we come over and go back to my pad because I have some more cash, don't I? I got a lot more cash. How much more cash do I have now? $5,050,000, don't I? So right now in my cash account, I've got what? 5,052,000. Hello? Okay, so I got 5,052,000 sitting there. Do you mind if I set up the due to the debt service fund? You don't mind? Set up, what was it, 50,000 due to the debt service fund? So I'm going to go ahead and set that up, right? I got 50,000 due to the debt service fund, okay? So I got this 5,052,000 sitting there, and I've gone ahead and I've got some money now from this bond issue, and I come over and now I'm now I'm going to crash the program. Is that what's happening here? Okay, still alive. Okay, so now what? I've got this money, and I'm accounting for that in the capital project fund using modified accrual accounting, right? Because I call it another financing source. At the government-wide level now, what? I'm debiting cash, I'm crediting bond payable, I'm crediting the premium just like you would in commercial accounting, right? And I'm going to treat that just like a commercial accounting situation as I amortize the premium, I pay back the debt, etc., right? Recognize my interest expense? Okay? Okay, good. Now you come over and you take a look at the next slide here. And the federal government sends me the money. Weren't they supposed to send me 100,000? Remember I set that up as due to? Remember I set it up as due to and I took the revenue. Now they finally send me the money. So I debit the cash. I credit the due to. Do I have some more cash? Do you have some more cash? So I'm going to go back to my cash account. And I'm going to go ahead and I'm going to debit that for now what? An additional 100,000? So now I've got what? 5,152,000 of cash sitting up there. So I'm accumulating quite a bit of cash, and I'm going to need it because I'm going to have to build this building, right? Okay, so I come over, and the general fund visits me. And the general fund says, I understand you were visited by the federal government and they give you some money. Is that correct? And we say, well, yeah. And they say, well, you know, we did loan you 50,000, right? So we got to pay the general fund back, don't we? Remember they had loaned us that money? So we go ahead and we pay them back that loan that we had. And so we come back, take a look at our cash account. Now we just credited it for 50, didn't we?
Is there no interest because they're not competing, or they're not?
They don't typically charge us interest. Who? What interest? For what? Oh, between the general fund? No, general fund doesn't charge interest on a loan like that. Yeah. No, they don't send us, they don't, it's not that we're not competing, we're the same, yeah, we're the same entity, yeah. They don't charge us interest on that. The federal government wouldn't like that. If the general fund charged them interest on that loan, then theoretically part of that 100,000 that the federal government just gave is going to pay interest to the general fund. Uncle Sam don't play that. We're not going to sit there and pay the interest on this thing for the government making money off of making money. That's crazy, right? And so no, they don't get into that. The federal government would say that's a no-no. We're not going to allow that expense. Okay? So anyway, but that's a good question, Caesar. Okay? But what happens when we go ahead and we credit this now, and I don't know if I'm drawing my line in the right place where I want to here. When we go ahead and we credit this now, it's what? 5 million, huh? 5 million what now? 102? Thank you. right? 5,102,000 in cash. Okay, so we just paid back the general fund their money. Okay, then what? Then we come back. Meanwhile, back at the project, we finally, start to what? Start to spend some money. So we sign a construction contract. When we sign the contract, encumbrance accounting, debit the encumbrance, credit the budgetary control, right? For the amount that we're going to be paying on this contract. You don't make budgetary entries at the government-wide level. Then what? Then the guy bills us, and he bills us for $3 million. When he bills us for $3 million, we do what? Debit the budgetary control, credit the encumbrance, debit the expenditure, credit the contracts payable for the full $3 million. Right now, we don't know what the final cost of this project is going to be, so we're assuming that the amount that he billed us for is also the amount we encumbered for here, right? So we just go ahead, reverse the encumbrance, set up the expenditure. So you come over, and if you go back to my cash account now, we just credited cash for $3 million. Was it 3 or 2? 3 or 2? We just credited the cash for. If you guys are going to go brain dead on me, I'm just gonna stop the class now. You can go home and you can figure the rest of this out yourself. Is that what you want to do? Okay, so we're going to go ahead and we're going to credit the cash for what? We haven't touched cash yet. No wonder you were sitting there looking at me. You were saying, why are you going to the cash account? Good point. So we haven't touched the cash yet, right? We only set up the payable. Okay, that's why you were looking at me like that. Okay, good. So, and at the government-wide level, we set up the construction work in progress. We credit the contracts payable. Okay, good. Now we pay the guy, but we don't pay him the full $3 million. We hold back 5%. Anytime you're having work done, you always hold back some from the contractor, don't you? Okay, one time I was having some work done, and I wanted the guy to change the side of my house to take the wood siding off. And he took the wood siding off, but every part but the little corner by the fireplace. And I'm like, why would I want that little piece wood and all the rest stucco? Well, you didn't say that. I didn't have to say that. I don't want that one little piece of wood there. Well, I'm not going to do it. Well, then I'm not going to pay you. It's quite a bit of leverage, isn't it? Okay. And he was a big guy. Okay, so what happens? You sit there, I'm thinking, he's going to throw me in that cement mixer in a minute. So anyway, what's happening? You don't pay the full amount, right? So they're not going to pay them all of that up front. They may pay the rest later, but right now, until they're sure they got all the work done, they're not going to pay it. So what happens? You come over, and now we credit the cash, what, $2 million. I guess I should stick with the blue. 2,000,000 what? 850,000. Is that what it was? So now the cash balance comes down to what? 252. Okay, good. So we're on our way, right? We're building this project. We go back to the project. The guy comes back a little bit later and says, okay, we're done with the project now. We're going to go ahead and bill you. This is the final bill. Well, since we encumbered $5,050,000, and we have now done what? We have now spent what? $5 million on this project. We go ahead and reverse the encumbrance for the remaining amount that hasn't been unencumbered at this point. Debit budgetary control, credit encumbrance, debit expenditure, credit contract payable for the actual amount, right? And at the government-wide level, of course, we're going to keep track of this asset construction work in progress. So now we spend we haven't spent that yet. We go over, and again, we pay, but we hold back 5% here that we hold back. So since we're holding back a little bit, we go ahead and we sit there and we credit cash for, what was it, 1,900,000 this time? Yep. And so now the balance in here is 352. Okay, good. So we're getting there. Now what? Now we go ahead and we do some sort of final inspection on this thing to make sure that we're satisfied with everything and they didn't leave a corner of wood undone or something. And we look and we're going to pay him the remaining amount we owe him, right? We held back a little bit on each of those. Now we're paying him that balance, which was $250 at this point. So we go ahead and we pay the rest of that balance that we had retained earlier for $250. I think they could have made this example easier by just leaving that out, but whatever. We're going to go ahead and pay the rest of that. Where's my pad here? Okay, and so that's going to be what, $250 more that we credited? How much, Caesar? Now we're left with $102,000. Okay, good. So we're left with $102,000, and we're sitting here. And do you mind if I go ahead and pay the debt service fund? Huh? How about we pay the debt service fund? Aren't we supposed to send them that $50,000? So why don't we just go ahead and send it to them now? So we say, hey, debt service fund, here you go. Here's the $50,000 that I owe you. So that's now down to zero, isn't it? Okay. And now we have how much left, Caesar? 52,000, right? Okay. Okay, good. So now we come over and we look at the project. We're pretty much done with it, so we make our closing entries. And when we make our closing entries, remember the other financing sources for $5 million? We debit that. Remember I made a big deal out of the revenue that was coming in from the government. That was a revenue. We close that by debiting that, don't we? We credit our expenditures. Oh, man. I forgot to keep track of my expenditures over here. Darn it. Why didn't somebody tell me? What were my expenditures? Trust me, it was the remaining. Let's just do it right. The expenditures were how much? I got it. That's why I write it down here. The expenditures were $3 million. And then $2 million, weren't they? 3 million and 2 million. So it was a total of what? 5,048,000 that we spent on this thing. Okay, so I forgot to keep track of my expenditures, but that's what we spent on the expenditures, the 2 million and the 3 million. So that's 5,048,000. And so just going back to the problem now, we have what? We're going to credit our expenditures to close those, aren't we? And we're left with what? 52,000 in our fund balance. That money is restricted because the bond covenants, right, external requirement means that money is restricted, and the bond covenant often says any money that is not used on the construction of this needs to be sent over to the debt service fund, right? So we've got 52,000 that we haven't used yet, right? Right? So what are we going to do? We're going to sit there and we're going to send that over to our buddy, the debt service fund, by debiting the transfer out, crediting the cash. We debit the what? The fund balance for the 52,000, credit the other financing uses transfer out, because we have to close those accounts, right? That's like a non-operating expense. We have to close it. So we go and we look back at the cash then. And if you look back at the cash now, because we just credited it for 52,000, didn't we? And so when we credit the cash for 52,000, how much cash do we have left? Zero. We've closed out our expenditures now, didn't we? We credited them for $5,048,000 to close them. Our expenditures are zero. Our revenues are zero. Our cash is zero. Our fund balance is zero. This project has been closed out, hasn't it? And it should be closed out because the stupid thing's done, isn't it? We don't need to keep track of that. That's what the Capital Project Fund does. It keeps track of resources coming in as we go through the project. It accounts for the funds being used for their intended purpose, the paying and the construction of this project, which is done now, right? So it should be zero at the end, and we close it out, right? Okay? Okay, good. Now you come over, and we need to make sure now that at the government-wide level, we no longer have construction in progress. We've got a building, right? Where once we had construction in progress, so we debit the building and we credit the construction in progress. Okay? Now, look, I'm not going to make you go through a detailed thing on your exam where you have to follow a bunch of journal entries through to find this, but you're going to see in your homework questions for this chapter and your quiz for this chapter that we're going to take pieces of this discussion and you're going to have to know how to account for that. In the back of your mind, you're understanding that this is part of a bigger picture in the capital project fund where we keep track of resources coming in. We spend out those resources for the construction of this asset, right? Okay? Okay, guys, that's enough for one day. We'll finish any straggling things from Chapter 5 in the slides next time. Hang on. But I have an expectation now that you look at the Chapter 5 quiz, which is up on iLearn, and take a look at those questions because we're going to start with that. And I don't want falling asleep, situation. I'm going to be calling on you to help me with answer those questions next time, all right? Okay, guys, I'll see you on next week. Have a good day.
Are you gonna provide chapter 6 for next week?
Yeah, I should. I'm supposed to. So maybe send me an email and remind me along about Wednesday when you're not seeing it. Yeah, if I forget, okay? Because I've been known to forget.